Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host. Today we have Eilon Shalev. Eilon is the founder of Elphi, a company streamlining the mortgage process. Welcome, Eilon, to the Private Equity Profits Podcast. I appreciate you joining us.
Happy to be here. Thank you, Cliff.
That means a lot. Thanks. First, tell me about yourself, including your MBA experience at MIT Sloan School of Management and the digital currency initiatives in the world-famous MIT Media Lab.
Sure. My experience at MIT was life-changing. I came in from a non-traditional background, spent 12 and a half years in the military, and came in to learn business. I spent a lot of time researching blockchain technology. When I started MIT, it was around September 2017. So it was before the first $20,000 Bitcoin price that shocked the world. So just before that, I started researching blockchain and got involved with the Media Lab. And we actually co-founded Blockchain Lab at MIT. And we've had somewhere between, I forget exactly, 40, 60, 80 even students, 14 projects that were worked on by students with phenomenal companies, Deloitte, BCG, Fidelity Labs. And through those projects for a year, my eyes were open to the possibilities of technology, and specifically in this case, blockchain.
Explain the blockchain to our listeners.
So according to some classes that I took at MIT, blockchain has 3 key pillars. The first pillar is cryptography. The second is decentralized consensus protocol. And the third is ledgers. And the combination of those 3 pillars, cryptography leading to a consensus protocol recorded on ledgers, on timestamped ledgers, that is blockchain, basically.
Okay. And our listeners could also reach out if they have some additional questions to yourself, and they can do some reading up on it. It's exciting. I think it's going to change or radically change in a positive way what finance looks like. I think we'll have some smart contracts that'll be put together that automatically will pay bills, and it will expedite being able to do business and really know who you're doing business with, and eliminate letters of credit and things of this nature because it'll all be automated. Tell me about your company, Elphi. What inspired you to start the business?
So Elphi is a loan origination system platform that we built for mortgage lenders so they can close loans faster. What inspired me and got me into the mortgage industry was pretty non-traditional. At the beginning, when I got to MIT and I was looking for a use case, as I was researching blockchain, I thought that we will focus on university, kind of create a university coin and use that coin in order to provide loans to students. And we wanted to democratize student lending. And after 3.5 or 4 months of research, I realized that technology may not be the catalyst for changing the high interest rates that students need to pay. And I thought that the idea, while laudable in terms of democratizing student lending, was implausible to execute. So that led us to research other areas within lending. And from student loans, it was pretty clear that to jump to the largest industry, which is obviously mortgage. So that segue from student lending to mortgage lending was because of the size of the market and the potential opportunities that we could unlock with better technology. And that led me to research that pretty extensively. And I, on top of my MBA credits, I actually wrote a thesis as part of my MBA studies. And during a year and a half of writing the thesis, it was pretty clear to me that there are so many inefficiencies in the mortgage industry, technology-wise, that could be addressed and should be addressed by someone. And during my 12 and a half years in the military, I spent 7 of them at least as a super admin of enterprise software that we use internally. And given my fondness of enterprise software, I thought it might be a good place for me to test whether my entrepreneurial skills and my business skills meet. And the intersection was enterprise software for the mortgage lending.
I'm glad you had success. I mean, you've got a customer already, you post revenue, which is really exciting. And, what is it you do differently that simplifies the mortgage process?
So in our case, there are 4 things that we do differently. The first is we provide open APIs. Okay. The second is that our platform promotes automatic task management. The third is our platform provides unlimited no-code configurability. And finally, we've got a lot more intuitive user experience and user interface than the other solutions that we've seen in the market. And the combination of those 4 things leads to shorter closing times and reduction of many errors that normally are done manually because of duplicative work. So we're cutting out all the manual duplicity of work and the synchronization across multiple systems with our open APIs and automatic task management capabilities.
Just for our listeners, the open API allows other software to actually interact with this software and transfer data sets into or cross share that information without any keystrokes. So that's why the error or reducing the amount of errors is reduced substantially because you took the human aspect out of it. And I think that's important. Functionality and the intelligence that you're building into your systems, I'm excited. How do you see technology evolving, how borrowers can obtain mortgages in the future?
Yeah, so there's I think there's going to be several steps within the efficiencies that borrowers will experience. I think that the first important efficiency that is still unlocked, it needs to be unlocked, is the connection between the borrower and the back office people. Today, I'll bring up 3 different lenses: the lens of the borrower, the lens of the loan officer or salesperson who helps the borrower apply for and obtain the mortgage, and the lens of it's called fulfillment teams or operations teams or the back office people. And the loan officers at this point in time in the mortgage industry, the loan officers are very centric. They're the key to the deal. And the problem is that after the application is done and the loan officer sent it over to the fulfillment teams, there's back and forth between the fulfillment teams, the back office people, and the loan officers regarding things that the borrowers need to provide and update and whatnot. So there's a by default friction point, whereas a conversation that could happen simultaneously across back office, borrowers, and loan officers actually happens with friction in the middle. And there's a lot of time that is wasted on back and forth emails and phone calls and sending files again. And we're trying to take that away by having open APIs where the software that is used by the borrower and the loan officer to communicate is connected directly and programmatically into our system and our pipeline of checklist items. And they are used by the back office people. So in that way, the borrowers will be able to receive requests directly from the back office people without waiting for those requests to filter through the loan officers. And the loan officers will be part of the discussion as well. So that's the first step. The next step, I think there's conversations around trying to bring down the number of days to close a mortgage from the average of 45 to, in the industry, to less than 10 days. Some people talk even about 5 days. I frankly think that less than 10 days is dangerous because these deals are pretty high volume, high ticket price, and borrowers should, this is the once in a lifetime decision for many of the borrowers when they take a mortgage. So for them to take a loan under 10 days, I think is a stretch. It's a very big financial decision. So, but I do think that 10 days is a good mark for the industry to search for, to look for in terms of efficiency unlocking. So for borrowers, I mean, it means faster closing times, and that means lower interest rates, because at the end of the day, the sooner the loan is delivered to the investors who buy those mortgages and portfolio them, or basically pull them into a mortgage-backed security, the sooner that happens, the higher the premium that the investor, in this case, I'll bring up Fannie Mae and Freddie Mac, will pay, because there's less interest rate risk. So faster closing times lead to higher premiums paid to the lender, which means the lender has more surplus to share with the borrower by lowering the interest rate. And I think that is pretty exciting outlook for the borrowers.
That was extremely insightful. Thank you for sharing that with our listeners. I mean, I don't think they all realize the continuity of there and how interest rates will actually be affected by speed to execution. And then the idea that we probably chatbots, in other words, that intelligent piece of it, that the file is not complete yet. So you really can't send it to the back office. Here's the pieces that are missing to help motivate and get those pieces in place. I mean, like the documentation that's needed to allow the back office to do their fine work. And then at some point, I'm assuming the back office could just work on things that are higher value, and you may be able to automate some of the lower transactional work. And that automation may, again, bring costs down, lowering interest rates.
100%, Cliff. And, one of the very common phenomenon is that a borrower sends a file, let's say government issued ID, whatever it is, W-2, you name it. They send a file, and then a week later they receive a request for the same file that they already sent. It happens so many times. So the idea, if they were able to upload that file into a portal that doesn't end there, but flows from that data storage into the loan origination systems data storage.
Excellent.
And by so doing, also checking the box of a checklist item, then the secondary request for the same file that was already sent will not happen. Excellent. And if you look at the number of checklist items that could happen or could exist within a mortgage, you could see hundreds of those. So there could be some loans with hundreds of items that.
That's a large.
So we're talking about massive efficiency unlocking.
Okay. And then the other idea is the OCR, being able to take those documents and add some intelligence. You were seeing some chat GPT-3 intelligence is actually being pulled out of those documents and then automatically allowing decisions to be made on qualifying, not qualifying, or alternative financing. Maybe they need to put more money down, be accepted for that loan. So that whole automated process and the back and forth, I can see it takes time. What are the biggest trends in the industry right now?
Well, Cliff, we're all familiar with the uptick. Uptick is an understatement in the Fed fund rate.
Okay.
And with that in mind, it's pretty clear that the mortgage industry, both lenders and tech providers and technology partners, are looking at cutting costs.
Okay.
On the lender side, it's a tricky formula to cut costs because some of their costs is spent on technology. And the idea of using technology is for efficiency unlocking. It's to create efficiencies within processes that are manual. So on the one hand, as a lender, do you spend more time and money on technology and hoping to cut the closing times and by so the costs per loan, or do you actually forego your investments in technology because those are fixed costs that you can actually control and risk increasing the time to close deals? So there's a very difficult conundrum for mortgage lenders at this time. And the other topic, of course, is the scaling down of personnel. It may or may not be the correct move for mortgage lenders, but these are the topics.
It's realistic.
Yeah, so these are the things that mortgage lenders are focusing on. I think the tech companies are definitely focusing on this, and especially I'm referring to tech companies that are VC backed. We can see seed, Series A, all the way through to Series D companies having to focus on cutting costs and focus now more on responsible growth and profitability as opposed to growing sales at all costs. But the flip side of this is that after a while, the interest rates can't just continue going up. They will have to go down at some point. And when that happens, there's going to be, again, a massive wave of refinance, because we're talking now on, we're talking about 7%, 6%, 7% mortgage rates. I mean, people who take, and the mortgage industry is still, there's going to be $2.3 trillion, I think, of the forecast according to the Mortgage Bankers Association in 2023. It's pretty large volume in terms of dollar amounts. In terms of number of units, maybe 4 or 5 million. I'm not sure if my numbers are 100% correct, but normally you would see 7 to 10 million. During the 2020, 2021 years, you've seen 12, 15 million units. So we're talking about a massive cut of number of units. So this means that, but there's at least going to be 4 or 5 million units that are sitting on a 7% interest rate or more. So immediately when interest rates go down back to 5 or 4, we'll see massive refinance waves. And at that point in time, the challenge will be scaling up for mortgage lenders. How can they scale up and handle the demand? And so how can they do that? Well, they can do that with better technology that allows them to scale up again. So cutting costs is a trend that, as I mentioned, preparing for the next refi boom is another trend that I see. And in addition, I think for the past year and a half, I've seen a lot of movement into the RON space, remote online notarization.
Okay.
Especially due to COVID. I think we will still continue to see adoption of RON, remote online notarization solutions, because it does bring efficiency in terms of coordinating so many parties.
So DocuSign is being a competitor.
Correct. All of those, and specifically title and closing software solutions are adopting, and they're providing the RON solutions as well as part of their suite of solutions.
Anything negative changes that we can expect at this point?
I think one negative change, obviously, is because the volumes of, in terms of number of units, that they go down. So we will see. I think we're seeing now layoffs, potential mergers and acquisitions. That on the one hand, it's bad for those who, depending on the price, of course, but some companies, of course, will lose opportunities for other companies to acquire companies that have to sell. And by so doing, they will create efficiencies in the future. But in the short term, I think layoffs, very high interest rates relative to what the industry was used to.
Well, cheap money creates inflated prices, single family, multifamily, large developments at this point. It's unbelievable what raw materials have done, when you look at multifamily developments. Toll Brothers, trying to go out there and build even single family homes. You could see some of the stress that's sitting in that industry with the higher interest rates and higher material, inflation. We live in an ecosystem and it has effects. I guess if you look back at 2008, 2007, the mortgage industry had large layoffs, the CMOs, there was some troubling in that situation, loaning money, somebody's got to pay that money back. Did prices for homes at this point get ahead of itself? Some folks may be upside down, and what is that going to do? So I think we'll find out. Also, we had legislation that was actually allowing people to stay in their homes without making mortgage payments, with COVID. And that's starting to be rescinded, or expire, that legislation. And that's going to create some additional stress on the mortgage industry. So we'll see how it plays out. You and I had spoken before we had a chance to interview, but there's a family sitting in that home with children many times, so trying to do the workouts, I think, is important to try to help the families to be, to be able to maintain their home and maybe elongate the time frame that they're going to have to pay it back. But they have to talk straight, and they got to make the payments. Eilon, is there anything else I haven't discussed that you would like to talk about?
I think you and I earlier chatted about some the use of AI and machine learning in operations. I think AI and machine learning are and machine learning specifically, by the way, in the example that I want to bring up, machine learning specifically to promote predictive models for the likelihood of loans to close. We actually had an experiment with, I'm talking about 2 years ago. We had 3 to 6 students in 2 different cohorts of machine learning that came for an internship with Elphi. And what they did, they ran some models on existing data that we had and checked whether they can predict the likelihood of a loan in an application phase to close.
This is exciting.
So it is exciting because of several reasons. Before we got the results of the experiment, I was very skeptic about, for lack of understanding, by the way, and lack of knowledge, out of ignorance, very skeptic about machine learning capabilities and applications. I didn't know anything. So I was initially skeptic and curious. So after the project, we realized, listen to this, we ran a linear regression. A linear regression model, several of those, to predict the likelihood of a loan to close. We've gotten to, I want to say, 70-something% accuracy. And then we did the same, took the same loans, same data set, and we ran 3 different types of machine learning models. The results were astounding. We've had 89%, 94, and 97.
Ooh,
like the 97%. That was pretty scary, I have to say. And the 97%, I mean, it felt to me maybe we've done something wrong with the data. Maybe it was, I don't know if that's, but it was pretty exciting to see. And then we added the feature just to test it out. And then as loans flow through the system, you would see the likelihood of that loan to close change over time because more data goes into the dynamically into the loan. So think of it now, what is the application of this, right? Okay, it's cool, but what is the application of this? The application of this was, okay, I'm a loan officer and I have 50 loans in my pipeline. I have 30 days this month. I know I'm working on, maybe I can close 1 per day. Actually, I have more than 50, I have 100. And then, so I have 30 loans I can close. I have 100 in my pipeline. Where do I prioritize my time? Do I go with the loan that came earlier? Like, do I go by application date? Do I go by closing date? Do I go by interest rate? Do I go by loan amount? Do I go by the neighborhood in which the property is? I don't know how to prioritize. Everybody has their own thing. We've spoken with several loan officers as well as people on the back office, and it was pretty clear there's not, except estimated closing date, which is okay. I have to close it because the estimated close date is tomorrow, so I have to focus on it. So except fire and extinguisher kind of scenario, there was no leading calculated way to determine which loans to prioritize. It was just putting out fires. So when we brought up this prediction tool using machine learning to increase the accuracy levels, we realized maybe you can take, so let's say it's 97%. So you take 97% times the loan amount, and you multiply that by the interest rate. Basically you can calculate the revenue that you expect to receive. And all of a sudden you can prioritize based on revenue, expected revenue that is pretty accurate. I mean, 97% is pretty accurate.
Very
So these are kind of things. This is one application that I was very excited about. And actually, when we spoke with lenders, potential clients about this, that was a very interesting tipping in our discussions with potential clients where that got them really excited. Now, I will say we do not have this feature live now. We've had more important things to focus on, but this was an interesting and exciting feature and a use case of machine learning that we are going to double down on when we have more resources. The other machine learning feature that we also looked into, which I'm also very excited about, and this is a dangerous game due to the nature of that feature, is providing insights to an underwriter about the loan scenario that they are underwriting at this point in time. Now, I'll give a little bit more context. When an underwriter looks at a loan, they look at many different, basically there's the 3 C's. They look at the 3 C's, 3 capacities. The capacity of the borrower to pay back, the capacity, the collateral. So basically they're underwriting the collateral, appraisal and all that stuff, the house, and the credit worthiness. So those are the 3 C's. And when they do that, they take into consideration a plethora of data points and information. So the idea here is to put a machine learning algorithm on top of all the data that exists in the system, monitoring decisions that were manually taken by underwriters. And then as soon as there's a new loan scenario, predict what the underwriter would have done in a prediction model. And then taking that prediction and telling the underwriter, and this is the dangerous part that I brought up earlier, providing the underwriter with a prediction of what that underwriter would have done if it were to just use the machine learning algorithm that looks at historical data, predicting what the next decision will be. And the problem with this is Elphi, as a technology provider, does not want to be a risk analysis company. So we don't want to take the liability of the risk analysis, but providing historical data and factual data to the underwriter in a conversational manner, where there's going to be a pop-up message telling the underwriter, according to 10,540 loans that we ran our algorithm, we estimate that this loan will be closed because of, or not, will be rejected because of X, Y, Z. 5,000 loans have been rejected because of this and that information. So maybe take a look and take a decision on your own. So kind of advisory role more than, not advisory role, reflective role, coaching role more than actual advice. So that was an interesting machine learning feature that we saw that I think is exciting, and I'm sure we're not the only ones looking at this.
No, you're definitely not. I speak on ethics in AI, how we're going to train the AI and machine learning. It's always benchmarking under a data set, so what an originating data set was and the future decisions that are being made. But that constant updating of current. But then the other side of it is you do have, the underwriter has the loss ratios. In other words, when something does fail and something goes into foreclosure, measure that against the earlier database, and now you really did come up with a level of confidence. Now, I could respect where you don't want to live in the space of, it's like a FICO score. Somebody's coming up with a number, and then they came up with, in essence, a dashboard. And it's color-coded, and there's a range of numbers, and there's a confidence level built into that for those that are underwriting loans or revolving letter, a credit. So, will you get pulled into that direction? That's up to you and your board, but the need is there. There's no question to it.
100%.
Yeah.
And Cliff, you brought up a very interesting point about the FICO score. There's a lot of companies trying to create some new risk assessment tools.
That's what it is. Yeah.
And I was really hoping that those upgraded risk analysis tools could also flow into the mortgage industry. And unfortunately, I'm embarrassed to say that I'm very skeptical about it, because those who actually take the decisions are not the lenders. The decision makers, underwriting wise, the real decision makers
Okay.
are the investors who buy the mortgage, and specifically Fannie Mae and Freddie Mac. And
Right.
so if Fannie Mae and Freddie Mac, they demand a specific credit score to be used, that's it.
That's
the
the
one.
federal government making decisions, what the criteria is. Now, the question is, will the government ever get out of the mortgage business? Interesting thought.
Wow, that's a loaded
It's
question.
a
Do you
long
have...
conversation at this point. But if we look at, we're going to regress a little bit, but it's a really good conversation. If we look at school loans and we look at mortgages and we look at the price inflation on getting a higher education, 50 to 70,000 a year, assuming a private institution. And then we look at the appreciation of a home, but if Freddie Mac and Sallie Mae, are playing an intricate role on the guaranteeing of those loans, and that's allowing the increases in the foundational real estate market. So, and the same thing with the increase on the university tuition levels. So I'm not saying it's right or wrong. It's just an interesting conversation, reflective on how government is actually stepping into a role that has long-term, effects on a market. It's not laissez-faire.
You actually blow my mind, Cliff, because as I mentioned, this is full circle. As I mentioned, I started researching the student lending space. Right. And we thought about, the original idea of Elphi was basically unicoin, university coin, as I mentioned, or create a coin. We wanted to peg that coin to the rising tuition cost.
Excellent.
We were very laser focused on MBA. So I looked at data sets. I was able to put my hands on, don't ask me how, on data sets of tuition costs at several business schools since the 80s or 90s.
Okay.
Even earlier, even the 80s. And I did an analysis of, first, I wanted to see whether tuition costs ever went down between 2 years, in two consecutive years.
Demand. Okay, yeah.
I never saw. I mean, I didn't check all the tuition costs, so take this with a grain of salt. But from those that I looked at, I didn't see 1 or 2 consecutive years where the following year had a smaller, like a lower tuition cost. So it always went up, or worst case was stagnant. Then I looked specifically on decades, or I grouped basically years based on the trends that I saw on the graph. It was somewhere between 4% CAGR and sometimes 7% CAGR. There were a few years with 9% or so. And even during the 2008 crisis and the ensuing years, tuition costs for MBA schools that I looked at went up. And it was insane. It was like, it's somewhere between 4 and 8% a year. And that's why we thought about the unicoin, where we wanted to somehow figure out a mechanism where we can allow students to buy a coin that is pegged to the tuition cost of MBA tuition, and then redeem it next year, and basically get a full worth of tuition, basically pegging your money to tuition, hedging. And so you brought up I looked at the Sallie Mae role in all of that. And as you mentioned, it all ends up with the investors who buy, basically those who actually fund. The actual funders are the investors who buy, the slabs, student loan, asset-backed security, or those who create the mortgage-backed securities, the MBS.
Right. But it's the federal guarantee that's allowing all that to take place, the fluidity in the market, but the escalation of the underlying asset, which is either an education or a real estate, portfolio, or, home, whatever it is, multifamily. So very insightful, very deep conversation. How can our listeners contact you? And are there any links that you'd like to share?
Absolutely. First, I am very attentive to my email, and it's my first name at elphi.io. So Eilon at Elphi, ELPHI.io. I'm also very attentive to my LinkedIn. So normally I prefer that people drop me a line and explain how they reach out. So I probably will not take a request if I don't see why people are asking to connect with me. But if someone drops a line, I heard you on the podcast, on the Cliff Locks podcast, definitely just let me know over LinkedIn, and we can connect over there.
No, I appreciate that. Addressing an important topic as 95% of founders don't know how to sell their companies, I've co-founded with a global team at the Hyper Accelerator, a new market-leading mergers and acquisition accelerator program to help founders prepare to sell and merge their companies with our 100-day global virtual accelerator program. The M&A Hyper Accelerator will prepare portfolio companies to be acquired and maximize their exit value, integration, and life post-sale. You can learn more about the program at startupcourse.com and click on the M&A application on the top navigation bar. Again, visit startupcourse.com and click on the M&A application. Thank you so much for your time, Eilon. You have enhanced our understanding of the complex topic of mortgage process underwriting, and our listeners will walk away with a better understanding of the value you deliver with Elphi. Thank you for sharing your expertise and your vision with us. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. The show has been produced by Market Domination LLC.